Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Matt Miller here in the Interactive Broker Studio with Norah, Mulinda. We are taking you through this trading day where equity indexes are absolutely ripping as rates come down. Norah, did you see the 10-year yield at one point was down 15 basis points? And that was the biggest drop that we've seen since August.
Wow. I mean, we are really on a roll here, at least in the equity market. I'm seeing NASDAQ up more than 2%, S&P up 1.6%. Lots to keep an eye on after that CPI data today.
Exactly. CPI came out. Well, the headline figure was still up month over month, 0.4%. But the core figure was only up 0.2%. We were looking for 0.3%. And that's what is behind the move. I want to talk about that right now with William Lee. He's the chief economist at the Milken Institute. And Bill, great to have you on the program. We'll just talk a little bit about the U.S. and then broaden it out to the picture globally because you have so much experience internationally. What do you think about the inflation picture? Because until today, the worry was inflation was back on the rise. The Fed wouldn't be able to cut as much as we had thought. And maybe, some said, maybe even would have to raise rates this year.
You know, it's always dangerous to go against the markets, but I still think rates, the inflation rate is on the rise. It really hasn't shown really signs of coming down ever since the fall. We have core inflation still hovering above 3%, and it's been persistently above 3%. But if you take away the goods and just look at services, that's where I'm really concerned, and that's where I think the Fed is concerned. We have services, ex-housing, forget about the housing component, over 4%. And that has been rising since late last year. So what we're seeing then is a situation where the downward trajectory to 2%, which the Fed really wants, really isn't in sight when you take away the goods disinflation, which we have seen take place because the supply chains have come back online. The real stubborn parts of inflation, the service sector, ex-housing, is the one that still shows quite a bit of persistence. And I think the Fed is going to keep things tight until they see that going into a downward trajectory, and we haven't seen that yet.
So, Bill, when we look at today's print, and as you were mentioning and talking about some of the details, do we think that the equity market rallying today is a bit of an overreaction?
Well, maybe yesterday's partial reaction to PPI and now today's reaction is just a sigh of relief that we are not accelerating upwards, that the overall index looks like it's relatively contained. But as I said, there are some vulnerabilities in that picture, especially when it comes to services. And I think if you're a real investor out there, you're going to be looking to see this rally fade and more uncertainty that is coming because of fiscal and international events is going to keep investors on edge and not willing to commit a lot of money just yet.
So what do you think about tariffs? What do you think about, the labor market right now? We saw a blowout number, let's not forget, last week, and the incoming administration wants to deport people, maybe by the millions. How does that affect inflation at a time when we're trying to extend tax cuts and also deregulate?
Yeah, I talked to a lot of investors, especially global investors, and I think the consensus view around the world is that the United States still is the best place to put your money. I don't believe much in academic studies, despite the fact that I'm a card-carrying PhD economist.
I was going to say, didn't you study under Robert Mundell at Columbia?
That's right, and one of the great luminaries of the field came up with a paradox. He said, isn't it strange that emerging markets where there's capital poor, you find that a lot of the investors in emerging markets and the rest of the world are coming to where capital is really rich. United States, developed economies, and that's called the Lucas paradox. And I think what we're seeing today is also the fact that a lot of people are saying, despite all this talk about diversification, I want to go where the returns are the highest, where innovation is the highest, where we're getting the most for our investment dollars, and it's the United States. And I think global investors really feel that way and continue to feel that way. All this talk about Trump and the uncertainties about tariffs and how it might be the end of the world, and we have a repeat of Smoot-Hawley of the 1930s and throwing the world into depression. I think that those are analytics that don't even pass Econ 101. Those would be F marks if I were still teaching at Columbia. And the reason why is because I think people should read Trump's book, The Art of the Deal, right? You always come out with a hard negotiating line, and then you sort of make a deal with people. And remember, Make America Great agenda, what's that all about? Maximizing high-paying jobs for Americans. That's really the agenda. And if foreign investors can come to this country and offer the opportunity to create more jobs for Americans, I'm absolutely sure the Trump administration would be jumping at that. Now, if it was China coming in, there's some high hurdles that they're going to have to meet. But in terms of our allies, the Canadians, the Mexicans, the Europeans, we are continuing to welcome investment funds to come into the United States to create new jobs.
But not the labor, right? I mean, we want to, during the campaign when Trump was talking about 15 million illegal immigrants, mass deportations were the signs being waved at the RNC. And in a tightening labor market, it just doesn't strike me as the smartest idea to send that many workers out. And not to mention the fact that we educate so many foreign citizens. Do we give them all the tools that they need to succeed and then send them straight home when they're done at our Ivy League universities?
And Matt, that's the paradox that I think all of the executives from Silicon Valley are trying to correct right now. The key word that you just said about immigration was illegal immigration. We want to sort of, I think the administration is wanting to put a clamp on the amount of illegal immigration, but they certainly want to optimize the amount of legal immigration, especially when we train a lot of the students. We want to be able to give them green cards to be able to stay here to make use of their talents. This country was built on the talents of immigrants from around the world, and the Trump administration has been saying all along they really want that. So the key is, how do you emphasize more talented legal immigration into this country? Although some people on the outside might call it a brain drain. But we've been draining the brains of the rest of the world now for decades and even centuries. And so that's not new for the United States. What's new for the Trump administration, the challenge is going to be to shift from the immigration being illegal status, less skilled, into the more skilled and talented immigrants that we've always wanted in this country.
William Lee, so great to get some time with you. Never enough. Hope I can talk to you again soon. Bill Lee there from the Milken Institute, where he is chief economist.
You're listening to the Bloomberg Intelligence Podcast. Catch the program live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Obviously, the whole market is ripping, not just on the CPI number and the lower rates, but probably also something to do with financials, right? I
Most
mean,
definitely.
They all beat.
Don't we love them?
And they're
Keep an eye
all
on them.
up pretty big. Even Citi is up like 5% right now. Allison Williams joins us right now from Bloomberg Intelligence. She manages like everything there, but her main beat is the banks. And Allison, I guess it's a $20 billion buyback that's helped investors feel good about Citi, but didn't they take down some of their goals for the year?
Well, I think they sort of notched down their return on tangible equity target in the near term, but I think it's realistic. It's interesting. Even Goldman Sachs, who had like a blowout quarter, really strong numbers, it's tough to see them. They say they have a path to reach their target, but I think what all these banks did was, after 2021, which was a blowout year, you saw a lot of people raise their targets, put out these very bullish targets. And JP Morgan has met their targets, but for everybody else, it's tough. And even with the markets as strong as they are. So, but
targets were pretty high, right?
Yeah.
I mean, Shonali keeps telling me that JP Morgan missed on equities trading, but equities trading rose 22%, right?
I think because they restated their numbers. And so if you look at the restatement, what happened was they shifted a little bit from equities to FIC. And so I think that's why it appears that they missed on the equities line, but really beat on FIC.
And FIC, explain to our
fixed
listeners?
income.
Okay,
currencies,
see us with
And
the
commodities.
acronyms.
Thank you. Yeah, it's an acronym that also doesn't do well in Germany.
Yeah, I'm not sure what it would be. Although Deutsche Bank only does FIC with one C because they're not.
That's good.
The more you
Yes.
know, the more you know. So,
there you go.
who's the front runner here, and who are the laggards?
So, JP Morgan really continues to post the leading returns of the group. As I said, they're, exceeding their target in the near term. We expect they'll meet their target again next year. But I would say that all the banks really had a good quarter, and it's not just the quarter, it's the guidance. And so net interest income coming in better than expected. Wells Fargo and JP Morgan in particular raising their guidance for net interest income for next year. With Citigroup, as we pointed out, they had the buyback is about 14% of their market cap, so that's pretty significant. I mean, keep in mind the valuation at Citi, and so that's why I think investors are even more excited about that.
Well, you know what? That brings up an interesting question. We have the inauguration in just a few days, and will be a different regulatory regime, not just throwing out the Basel III endgame, but I wonder if these banks are going to be able to do more buybacks. Are they going to be able to pay more in dividend? Are they going to be able to return more cash to shareholders?
That is definitely the thesis, if you will. And so a lot of the run-up that we saw in the banks was due to this lighter regulatory environment. A big part of that, to your point, is the capital rules. So Basel III Endgame, as we call it.
Sounds like a movie.
Yes.
Right.
So it will eventually happen. I mean, for the banks, it's probably a good thing, actually, if it happens under the current administration, because the current administration, as we know, is very U.S. focused. And a lot of the issues that the banks had with the capital rules was that it was very punitive versus some other jurisdictions. So it felt like it put them at a disadvantage, especially in something like prime brokerage. And that's not a business that regulators are necessary. Regulators generally, they're looking to protect the smaller banks and do things that, they're not as concerned with trading and prime brokerage. But to the extent that this administration, we would see the lighter rules come through, it could be good to get them solidified. The other thing, M&A, less antitrust should be good for M&A.
Right.
It's actually a little bit of a
How
disappointment.
many banks are there in the U.S., in the United States of America? How many banks do we have?
Well, it's not
5,000?
It's not necessarily even the bank consolidation. It's the fees
So
that they'll
many of
make
them.
advising other people.
Oh, right. Okay. So
Other
you're saying
people.
advising M&A for other industries.
Right.
Okay,
I thought you were
okay.
talking about in banks because,
Nope.
in some countries they have like 4 or 5
Right.
banks.
Right, just a couple that you can count on your hand.
And in this country we have
We have a lot.
a lot.
5
I'm
million.
not far off with 5,000, right?
Yes, so you're not far off, but I mean the size of these GSIBs, as we call them, which globally systemically important banks. I mean the big really have gotten bigger. They have consolidated share, and they've gotten bigger globally.
I don't know if
Interesting.
Norah remembers, but there was a time when we were concerned about banks being too big to fail.
Okay.
I mean, you were probably in middle school at the time, but now they're
You don't know that.
even bigger. I don't know that. I shouldn't assume that your age is, but 2010 now is 15 years ago. So
It's interesting how times have
2008,
changed.
right? 17 years ago. What grade were you in?
17 years ago.
I don't think I'm allowed to ask, actually. Forget that I asked. In any case, these G-SIBs are G-SIBier than ever.
Right. So I keep an eye on real estate stocks. So I'm covering office REITs. And one thing that I'm always looking at is return to office. So we did have JP Morgan saying that they're pushing people back into the office. What has been the general mandate and what has been the conversation for the banking industry in general?
In general, those that are front office, if you will, that are out there, we have this banking fee recovery, banks are competing with each other. So a lot of those senior people have been in office or traveling again, right? So a lot of, for investment bankers, a lot of it is not necessarily sitting in your office, but being out there and visiting clients. So we definitely saw that return to travel. And JP Morgan, even though the 5 days a week is getting a lot of headlines, the senior people at JP Morgan have already been back. People that I talked to at the company were back, May of 2020, they were back in their office 5 days a week. So Yeah, so definitely there is the return to office. Commercial real estate, as you know, was a big concern about a year ago, or I guess.
Yes, talk to us about where that stands
now. But we're definitely seeing some stabilization there. And credit, you know, we talked about the net interest income side of things. When you don't hear about credit, it means it's good.
Okay.
And so, you know, the office, commercial real estate is a significant business for Wells Fargo. We're always looking at the trends for them, and we saw solid quarter overall net charge-offs, very stable provisions, less than expected at Wells and JP Morgan, and that's a clear signal for Bank of America. And it also means that the credit outlook for 2025 feels good. And lower rates have really helped on the office commercial real estate front.
Interesting.
Yeah, very interesting stuff. Allison, thanks very much. I'm sure, is today the busiest day of your year?
Today is the busiest day. Because
but you look calm and collected.
Normally we have 3, but today we have 4 big banks that I look at. We had BlackRock, we had Bank of New York. So
yeah.
So busy bank day, but it's always easier when the numbers come in solid,
right,
and the trends are good.
And you're tackling it.
Allison Williams, thanks very much for that. She covers all the big banks for us at Bloomberg Intelligence.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
John Tucker, Norah, Mulinda, your subs today for Bloomberg Intelligence. As Lisa just told you, risk assets, well, bonds too, also surging after today's inflation news. Let's get some more insight. Lauren Seidel-Baker is economist and senior consulting speaker at ITR Economics. So, Lauren, you know, I get it. Core is down, but is this an overreaction? I mean, it's not down that much.
It's not down that much. If anything, I see this as a continuation of the trend we've been on. We like to see those splitting hair surprises to say core not, you know, quite so elevated as we had been. Certainly beat expectations. The market's going to like this for at least a few minutes, but I really think this keeps us on track with the trend that we've been seeing.
Lauren, what really stuck out to you through this report today?
So it's good to see shelter costs. Those contribute for just such a large percentage of overall CPI. Still rising, still one of the stickier aspects, the stickier components of inflation, but starting to cool off a little bit more. Again, housing affordability is going to be a concern going forward. We know that. We're seeing more folks looking for rents, right? Demand for apartments is up, but vacancy rates very, very low for apartments. So the rental component, I do expect that to be a little bit stickier going forward. Otherwise, though, the big drivers here, things like airfare, medical care, those are things that we know do cost more. So no big surprises, especially on the core front. I think this is a manageable result. And I think this, again, keeps the Fed on pace for those 50 basis points of cuts this year.
Okay, so maybe we're headed, the trajectory is headed in the right direction. But you know what? Maybe tariffs are headed our way, and there are a lot of iffy situations coming up.
Yes, tariffs are a big one. We have seen, if we break down inflation to the goods components and the service components, goods really have been mundane. Now, in this most recent print, energy prices starting to come back. We have been enjoying lower oil prices, right? Lower gas prices at the pump for a while. Starting to see a little bit of pressure building there just with the macro cycle picking back up. But if we do get in, tariffs, especially those universal tariffs, that could drive more broad-based inflation on the goods side of things. Service sector, again, the labor market is tight. It is going to remain tight for the foreseeable future. So our base case is just for wages to cost more, for wage inflation to be higher going forward. It's really the risk to me if tariffs bring the goods side back to keep up with the wage side of things, with the service side. That's when we could start to see inflation really reignite.
When we think about the idea of tariffs, Lauren, are there any particular sectors or industries that you're keeping an eye on?
So much of this remains political at this point. Maybe we'll get one company asking for waivers on one thing or another, but really, if we do get tariffs that are universal tariffs, that just affect everything coming into this country, not targeting just China or just, some other jurisdiction, some product line, that's where I see the real risk. So I'm waiting to see what the incoming administration releases for their policy proposals. Some of this might just be campaign rhetoric that they leave behind on the campaign trail. They do target those kind of high value, really buzzy items like steel or things that are more targeted to China. I just think at this point it's a political decision. I won't be a political analyst. I'll just analyze the economics of it.
Lauren, as we think about the trajectory for the Fed's policy this year in 2025, is the focus really on employment data, inflation data? It feels like that has shifted as we've been moving the past couple of years. What are you keeping an eye on? Which prints really are most important to you?
I am absolutely focused on inflation. So we have seen the focus shift from Fed messaging in recent months and quarters. Really, that's because when rates started coming down, they're looking at the employment side of their dual mandate. They're saying we don't want further loosening in the labor market. As I follow the jobs market, so much of that is just based on demographics, the number of jobs we need to fill versus the number of workers we have to fill those jobs. Right now, that is still not a 1-to-1 ratio. We have more than one job opening for every one unemployed worker. So if we're looking at loosening in the labor market, I don't expect a major recession, a major economic event this year. What could cause that loosening is more people coming in, right? More either students leaving school, aging into the workforce, more existing prime age workers looking for jobs who hadn't been participating in the labor market. Neither of those things seem particularly likely right now to really sway the tide. So I see the labor market as, yes, directionally loosening, but still very tight by historical standards. And that isn't going anywhere just due to the numbers of people and how they balance out. So with that said, the Fed can't really put too much pressure on that side of the scale. And inflation is the side. We have a lot of fundamental drivers that are starting to signal inflation picking back up, especially by the latter half of this year. So my concern as an economist is, we don't want to take the eye off the ball of the inflation side, because if that does pick up, I think there's a very reasonable chance that we could see the Fed start to talk again about raising rates by late 2025. I don't think that's off the table.
So as an employer, I can attract employees because I'm going to pay them more?
At the end of the day, you can do a lot for culture. You can reach out and have a mission.
Well, no, I'm getting to the inflation component, culture.
Okay. No, but at the end of the day, that's what folks are looking at. How do you attract someone to you and not the group across the street? This generation is a little bit more willing to move. We love the mission. We love to be part of something. But at the end of the day, the dollars are what make it work. So yes, that's why wage inflation is so elevated, and I would expect it to continue to be so.
The culture.
The culture.
Well, I get to work with Norah. That's why I'm here.
I get to work with John.
Oh, it's a real love fest, isn't it?
And it's not even February yet.
What's your expectation for, we'll put you on the spot, when are they going to cut? Yeah, you mentioned raising, actually.
Mm-hmm. As for when they cut, I don't have a horse in that race. I think 2 more cuts is a reasonable expectation, but if it's only 1, I'm not going to lose sleep over that. Directionally, we're seeing rates increase. We've already seen inflation expectations bring kind of market rates back. If you look at even mortgage rates, those are back above 7% this week. So the impetus is really to the upside, especially by second half of this year. So the ultimate timing of that exact low, the exact level within 25 basis points, again, that doesn't matter big picture. We don't need to split hairs. We need to look at the general direction. If you need to do borrowing, either as an individual or business, this is probably the time to do it.
Lauren, you mentioned that shelter costs are still a bit sticky. Can you just give us a bit more detail about what's going on in the housing space?
Sure. Housing is tight. We have been underbuilding homes in this country. So household starts have not kept up with new household formations. We just need more inventory. Now, that's a hard thing to do today where mortgage rates, as I just said, are above 7%. That is really taking a bite out of affordability, not to mention the value of those homes. The list price has also really picked up since 2020. So it's a tough scenario out there for would-be first-time home buyers just trying to make those dollars stretch. And we're also seeing much less inventory come on the market up for sale. So existing home sales have been more subdued with, as I'll say again, that rapid rise in mortgage rates. Why would I sell my house with a 3 or 4% mortgage rate if I have to buy another one with a 7% mortgage rate? That's a lot less house that I can get for the same monthly payment. So we're seeing folks just stay in place a little bit longer. In the past, I'll say 6 to 9 months. A lot of folks have started to just bite the bullet. If I really need to move, I will do so. But again, affordability is the big constraint there. That's what's keeping many individuals in rental situations for longer rather than going out buying that first home. And those problems really aren't going away. So affordability is the name of the game. What's going to matter is balancing that aspect with the wage inflation I was just talking about. More people being employed, making more money, they have more money to spend on everything, but housing is one major expense. So we're seeing some improvement in just our ability to afford housing, but the affordability numbers themselves much worse than we were just a few years ago.
And just anecdotally, I should point out, at 3.2%, they're going to bury me in the basement. Of course, if the price is right, I can be out in 10 minutes.
That's true. You all like to brag. Anyone that has a great mortgage rate in place, we got to hear about it for sure.
Oh, Mike McKee, 7%? What does that do?
That keeps people sitting on their hands. Although the interesting thing is it came out of the same day we saw a 33% increase in mortgage applications last month. Most of that was refi, and I'm not sure why people were refiing when rates go up.
I'm curious.
But Mike McKee, stop. Lauren, I didn't mean to upstage you. Lauren Seidel-Baker there, the economist, senior consulting speaker from ITR Economics. Thank you very much for stopping by today. Mike McKee, our economics correspondent, among other things, hanging out his shingle. What was your big takeaway from the inflation report this morning?
Good enough. It wasn't too hot. It wasn't too cold. We had a little bit of extra strength in the headline, a little bit less in the core. Both went up on a year-over-year basis, but less than anticipated. So the markets are taking that as good
I
news.
wasn't too excited. But the equity market, even the bond market, is pretty excited about
NASDAQ up more than 2%.
Well, I think you're not looking at anyone in the markets who's looking at what the actual impact of this is on the economy, and they don't expect it to affect the Fed meeting on January 29th. Everybody's waiting for next Monday. And what does Donald Trump do? So there was all this nervousness in the markets, and everybody was pushing yields up, which hit the stock market. And today, it gave them a reason to exhale. Wait till the end of the week. We'll see as people get more and more nervous about what Trump may do, whether that continues.
Yeah. As we think about this in about 20 seconds or less, how are you thinking about the fact that we are still not at that 2% target? What do we need to do to get there?
Keep it up. And that's why the Fed may keep rates on hold for longer than possible, or longer than thought, because they've got to keep, at this point, the pressure on to keep it going down towards 2%.
Okay, Mike McKee, Bloomberg International Economics and Policy Correspondent, reacting to 7% mortgages and today's CPI.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Well, we have got a great guest here. We have Seema Shah. She's the Vice President of Research and Insights at Sensor Tower, and she is here joining us to talk TikTok.
Yes.
As we know, there could be a ban upcoming, and so we're just trying to talk about the mechanics of what could be happening.
We're waiting for the Supreme Court to rule, frankly.
We're waiting for them to get back.
Literally any minute.
Waiting for them to get back to us.
Yeah, exactly.
Presumably before Friday.
Right, before Friday it would be ideal. So tell us what's going on here and what expectations should be. Is there any movement here with the Supreme Court, and is ByteDance intending to budge at all?
Right. So I can't speak for the Supreme Court. Unfortunately, I don't have any insight into their decision making. But I will say that what we're seeing, what we expect to see first, if it is banned, what we expect to see, and I think I spoke about this with Paul earlier, is an ongoing shift to Meta platforms, specifically Instagram, because of Reels, and to YouTube's because of Shorts. So if you think about when we look at how much time people are spending on an app, 42% of people's time on Instagram is on Reels. 28% is on Reels for Facebook, and 27% is on Shorts for YouTube. So short form video is obviously a key driver of engagement, which is all that TikTok is. So we expect that should it be banned, we would expect more users to go there. But there's more at stake than just users and hours engaged. It's also in-app revenue. About 22% of ByteDance or TikTok's in-app revenue comes from the US, so that's a huge chunk. And when we look at the digital advertising space, we see about 9% of ad spend is on TikTok. So these are all dollars and hours engaged that would be up for grabs.
Hang on a second. TikTok, 28%?
22%.
22% of their revenue comes from the U.S.
From their in-app, of their global in-app revenue.
But what percentage of in-app, Instagram's in-app revenue comes from China?
Now that would be an interesting question.
That China data is a little trickier for us to procure, as you can imagine, but Instagram
I was
and
only
YouTube.
posing that question because Instagram is banned in China. Facebook is banned in China. Snapchat is banned in China. Pinterest is banned in China. No U.S. social media apps are allowed in China, and yet we allow Chinese social media apps to cash in here. If the kids aren't using Instagram, aren't using TikTok, they've started downloading Red Note, which is also Chinese, and Lemonade, which is also Chinese.
Lemonade is also owned by ByteDance. So they're both Chinese Chinese apps, and we've seen surges in download growth of those two apps starting at the end of last year. And particularly in the last week, we've seen a big bump in Red Note's downloads over 100%, ending through Sunday from the prior week. So there's definitely surges of users downloading these alternative apps. Even my teenager mentioned it, which then it's in the media when the teenager knows that. So we're definitely seeing that surge, but that doesn't really make sense if the app it's banned because it's Chinese, because these are also Chinese owned. So I'm not sure how that would work in the long run, or if people would just move over and eventually those would also get banned if they do. But the other social media apps like Instagram and YouTube don't have the same in-app monetization that TikTok does for creators and stuff. So they would have to evolve their own platforms to make it as lucrative for creators as TikTok is.
I'll just clarify for the sake of those of you using a ton of TikTok.
Why, I don't know who you're looking at.
Why majorities of both parties are against it. So
he's looking at me.
One concern is that the Chinese could use your data to spy on you or to blackmail you.
Okay.
One concern is that China could shape the algorithm to send out more misinformation or stir up social unrest. And another concern is that China could use software updates for TikTok or Red Hat or Lemonade,
Red Note
to infiltrate your devices and to implant malware on your stuff.
Valid concerns.
Right? Yeah, but no one cares, valid. Right? Nobody cares.
Apparently not.
It's a more useful demographic, so I guess they don't.
But Donald Trump also doesn't seem to care, so
we'll see how much
I think he did care, and then he pivoted, and now he
doesn't care.
Doesn't care.
Right, because Jeff Yass from Susquehanna, who has a 15% stake in ByteDance, has given at least $8 million to a Republican super PAC.
Okay. Well, also Donald Trump has his own social media platform.
This is true.
Which is very small, but it has grown significantly since during the time
Truth
of the election.
Social.
Truth Social, yes.
I wonder how that does in China.
So, as we think about the app, what are the largest user base? How much, you mentioned 22% of their in-app revenue comes from the United States. What about users?
Users tend to skew younger. About 10% of their monthly active users come from the U.S. But we've also seen, this is sort of a separate secular issue, we've seen a little bit of, I would say, mobile app fatigue, where you're seeing a pullback in usage across dating apps, streaming, across the board, including social. So that's sort of a secular thing. And within TikTok, because it grew so fast and was sort of the first mover in short form video, it's seen a pullback. Like its monthly active users were down in the fourth quarter 1% year over year. DAUs were down 4%. So it's not seeing that same growth that the other platforms are seeing because it was already sort of saturated.
Interesting. My main question is, what does this mean for small businesses? Because you've seen a lot of businesses that have actually blown up through the use of TikTok, or maybe you're introduced to new brands through the app. So I'm curious how that will actually play out, and if that's been a conversation.
I think they would be forced to try to move to Instagram or to YouTube and try to monetize on those platforms. But again, I don't know if those are established or set up to be as lucrative for the creators. So they probably would have, with demand, be forced to evolve their own platforms. But I think that would obviously be a huge impact to those businesses.
Why are those American-owned apps? And by the way, I use the term very loosely. I'm being a little bit tongue-in-cheek, right? They're obviously publicly traded companies. Anyone can invest, not just American citizens. But why aren't they as popular as these sort of ByteDance-owned apps?
Well, TikTok in particular was sort of the pioneer in short form video, and that is what.
When I was a kid, we had Vine.
Popular, and that's why
You were a kid then?
No, I was already old. You're right.
Well, that's why you saw the surge in investment for Reels, for Facebook and Instagram, for Shorts, and I believe Snapchat is building out Spotlight. So short form video is where people's attention and engagement is going. So because
it's so short, the attention span.
Literally, and in fact, because of that, it's actually a competitor to streaming and things like that. Because time is finite, dollars are finite, right? So it's much easier to watch a less well-produced 1 minute video than a whole show, right? And you're even seeing a sort of the rise of short drama apps where there's these sort of very poorly acted stories that come out and you watch a minute of it.
Seema, we have, unfortunately, running up against the clock. We could have had you on for the whole hour
because
it is fascinating stuff, and your data is really fascinating as well. Seema Shaw, Vice President of Insights over at Sensor Towers, and they collect that data.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.